Folks, you better fasten your seatbelts. In today's video, we are going to be walking you through the top 5 stocks primed for crazy growth. Now, each of the stocks on this lovely list are solid buys. However, we are going to go through the why, fair prices to pay, solid strategies, and how to take advantage. And keep in mind that each of the tickers on this list also have real massive growth behind their businesses and or upcoming catalysts, so they aren't baseless hype stocks. Let's get to work. Timestamps down below, and the only thing I ask in return is that you hit that ravishing like button, turn on the notifications, and subscribe if you find value in the content. And as always, never buy a stock or option just because we talk about it in a video. You must do your own research and come to your own conclusions. If you're the one taking the risk, you got to be the one doing the ultimate frisk. Okay, so before we get into the top stocks, we need to discuss market context. Markets have been super hot all year. We've been building over all-time highs, and it's been great. It's been fantastic. The triple Q index, basically the NASDAQ 100, is up almost 46% year over year. The S&P 500 is up almost 32% year over year. However, over the last couple of weeks, you're starting to see some euphoria leave markets. Some of the Mag 7 stocks are just melting value. Apple is down almost 13% since late January. Tesla is down some 34% in terms of some of our favorite names here on the channel. Palantir, Mara, well, they've joined a pushback the last week or so as well, with many of the other small cap stocks seeing a bit of a take profit cycle. And while overall it's hard to say much if any of a pushback is happening in the broader markets right now, well, there's still some clear reasons why you should continue to see some breathing, a breathing zone for overall markets come in the next week or two. Number one reason is the new debate on inflation. The CPI index earlier this week was slightly hotter than expected at 3.2% instead of 3.1%. That may not seem like a big difference compared to what we had a year ago, but it still shows inflation being more stubborn than expected. We also got news that wholesale inflation rose 0.6% on a year-over-year basis. The headline index increased 1.6%, which makes it the biggest move since September 2023. Now, to be fair, the Fed is still sticking with 3 2024 cuts despite higher inflation, but higher inflation numbers have presented a new risk to the bullish market thesis that just simply wasn't there a few weeks back. And that's enough to drain some of the euphoria out of the markets, and that's what I believe is starting to be the case. Right now, you're entering into a market that's going to breathe for all but the stocks that are most relevant in today's cycle. The second trigger for a breath cycle is just, quite frankly, something we see in every season. A lot of the run you saw the last couple of months was driven by a massive earnings season, which had high expectations going into it, and most of the expectations were beat. And now, quite frankly, earnings season has passed, and we are in the waiting zone between Q4's reporting season and Q1's reporting season. And in that waiting ground, you just simply tend to see more breathing. And the third reason that we're due for a breathing cycle is just naturally, you're going to have a testing period, a breathing period in any sort of unprecedented run. Most folks in the markets don't feel comfortable buying momentum that is straight up forever. It simply needs to steady out for a little while and build support, and I believe that's what you're going to start seeing in the coming weeks. But bigger picture, folks, right now, the way that a trader would look at this market is, hey, we're in a very aggressive, euphoric, opportune bull market, and the trend is your friend until the trend bends, and then it's no longer your friend. So right now, if you're looking at the market and you're looking at any dip, a dip in the overall market, a dip in a hot name is an opportunity to, sure, play the downside dip a little bit, but also understand that that dip is likely going to get bought up again and aggressively. And that should be the operating thesis until you get a trend break, which is a 10% change in the direction in the overall market, a 10% drop. Right now, we don't have anything close to a change of trend. So for people calling that this is the top and we're never going to go up again, well, you're just simply not trading with the trend. You're trying to trade against the trend. Riding the trend is very smart. Trying to predict the trend is a very big mistake and has aged horribly for people who have bought the dip that kept dipping or for people that have shorted the rally that kept rallying. So anyways, with that in mind, let's talk about the top 5 stocks to buy right now. Number 1, Hood, Robinhood. So Hood has been on a momentum cycle, a pretty aggressive one, and for good reason. Context, of course, if you have been living under a rock, well, Robinhood is a leading financial services company, big broker for the retail trading community, and they're one of the first ones to introduce a lot of the key features like commission-free trades and simple interfaces for new traders. Now, I've had my criticisms on how Robinhood has handled certain issues in the past, but we'll let bygones be bygones because their numbers are pretty damn good right now. The truth is, I've been watching Hood for a while, and quite frankly, I've been shocked at how much of the bounce back in retail trading its stock price has missed while its business has boomed. Its stock just barely started waking up. A lot of people are getting back into markets right now to trade stocks and especially crypto to take advantage of the bull market. And so companies like Robinhood are benefiting huge and prone to benefit more, but the stock just hasn't reacted until maybe a few weeks ago. And even so, it's very small relative to what their business should be doing and what their competitors are doing. You look at Coinbase, which is of course crypto focused, but I mean, they've gone from $31 to $251. That's an 8x. Again, Robinhood barely just started taking off the last couple couple of weeks, you look at Robinhood's business model in terms of total trading volume. From a month-over-month perspective, equity trading volumes are up 36%, options contracts are up 12%, crypto is up 10%. So you're seeing a lot of growth month over month, specifically in equity trading. And that's likely to have continued in March and is going to make for a hot Q1 and Q2 report once we get them. But a lot of people are especially sleeping on this crypto segment. Year over year, crypto is up 86%. And as more and more people hear about crypto breakouts and so-called fast money to be made in crypto, well, Robinhood will be a big benefactor of all that extra trading volume. Now, sure, someone who is of intermediate level of interest and knowledge in crypto probably would never use Robinhood. Robinhood is far too basic and you don't even really own your crypto. But I'm not talking about intermediate people entering markets. People that are really interested and invested in crypto, they've already been in crypto and entered years ago. I'm talking about the people that are only interested in crypto when huge euphoria bull markets are happening. They want to get in, they want to make their profits, and they want to get out. And Robinhood, in my view, is going to be one of the biggest benefactors of that market coming back. And they've been coming back full swing. And whether you're talking crypto or the stock market, it's really the same deal. You look at the data, even on the people that are sitting just on Robinhood's platform right now, there's a lot of firepower there. You look at Robinhood's total assets under custody, I mean, they are approaching $118 billion. That's a year-over-year change of 59%. And I mean, come on, $100 billion plus in assets signals a huge amount of opportunity for Robinhood just within their ecosystem if no one else comes onto the platform. When people start trading that money more and more as markets go up and up and up and up, that's going to be a ton of money back into Robinhood's bottom line. Look at their financials. I mean, even last year when retail trading was fairly weak, things were turning around fast for Robinhood. For the full year 2023, Robinhood reported a record revenue of $1.9 billion, up 37% year over year, alongside a fourth quarter GAAP net income of $30 million. This profitability signals a pretty significant turnaround, especially considering the brokerage's focus on expanding margins and driving profitable growth throughout the last year. Robinhood's average revenue per user, the ARPU, has also seen consistent growth, reaching its highest in the past 2 years during the second quarter of 2023. Importantly, Robinhood has achieved GAAP profitability for the first time since its IPO, marking a pivotal moment that could attract a broader range of investors looking for profitability and value-oriented investment. Now, aside from that, folks, some analyst firms are coming out and saying that Robinhood has a lot more upside as the crypto market alone is to see a triple in size. Bernstein's analyst said, quote, "We expect the crypto market to triple from here to go to almost 7.5 trillion in terms of market cap." And given obviously that Robinhood is among the few brokers who provide a full suite crypto platform, we expect that flexibility to kick in. Now, in terms of a good price, let the current euphoria breathe a bit. I'd say support at $16 and below is fair, but I also see a strong chance that you see Hood dive back to support at $14 in this cycle and then see a nice run back upward, and that would be a really good deal. So Hood, I believe, should be atop your radar right now for a potential dip buy at about $14 a share. My guess is that after the next earnings report, you're going to see this head well into the 20s, so anything about 14, 15, $16 is a good damn deal. Number two, Palantir. So if you could pay a company, say $100 a month for a subscription that saves you 25% of your expenses and makes you 4x more productive and 4x more money, would you do it? Well, that's a watered down simplification of the choice that major companies are making. Palantir is that company that can save you a lot of your expenses and make you a ton more productive and thus a lot more money. Palantir specializes in big data analytics, offering platforms that help major companies and institutions integrate, manage, and secure their data and make better operational decisions. Now, I seldomly make a top stocks video without including the tier of the Palin in it, and that's because it's for years been one of my most believed in top plays. But what's special about the tier of the Palin is that there's just so much of a disconnect between what the company should be valued at and what it is valued at. Being a big data company with some complex software behind it, I mean, there's just simply a lot of room for regular investors and market analysts to simply really misunderstand their business model. There's also a lot of room for short sellers to distort, and boy, have they been distorting. The CEO said this just the other day.
I love burning the short sellers. Like almost nothing makes a human happier than taking the lines of cocaine and away from these short sellers who are going short on a truly great American company, not just ours, but just love pulling down great American companies.
And folks, you know what? He's right. Nearly 50% of shares exchanged on the off exchanges are short volume. That's about 12 million shares. This is according to Fintel data. When you're dumping 12 million artificially created shares, it's just simply very easy to suppress upward movements. Short sellers are essentially making an offering every single time the stock goes up, offering tons of shares that didn't exist and creating a massive increase in the supply of shares. And this has been happening for years, which has almost certainly created this expectation that, hey, if you're buying the stock, expect to be crushed crushed by the shorts. However, the fact of the matter is that shorts can only win for so long, and they're starting to see tides turn, and that's because investors are looking at the numbers. This is what Palantir reported for Q4 2023. U.S. commercial revenue grew 70% year over year and 12% quarter over quarter. Commercial revenue grew 32% year over year and 13% quarter over quarter. Revenue grew 20% year over year and 9% quarter over quarter. Palantir closed 103 deals over $1 million, 2x versus a year ago. The U.S. commercial segment grew 55% in terms of total customers. That's year over year and 22% quarter over quarter. Adjusted free cash flow, they reported $305 million, which is a 50% margin. Adjusted operating margin, they reported 34%. They reported their fifth consecutive quarter of expanding adjusted operating margins, the fourth consecutive quarter of GAAP operating profitability with an 11% margin, fifth consecutive quarter of GAAP profitability. And these are just some of the metrics of this massively, massively booming business. And sure, if you look at the stock, Palantir has indeed recovered some of its valuation in the current bull market, but it's trading nowhere near the multiples that other AI-related software stocks are. And in my view, if it wasn't for the aggressive short-selling campaigns, Palantir would probably be trading somewhere around $35 to $40 a share. And so with Palantir dipping back into the low 20s right now, I see that as an opportunity, and I see that as it's getting back into good deal territory. With practical AI adoption in full swing, I believe 2024 is going to age to be a home run for this company, and as earnings reports come out, you'll see a similar trend where Palantir beats on earnings and the stock shoots upward and completely crushes shorts. Okay, number 3, Alibaba. So Alibaba stands as a behemoth in China's e-commerce and cloud computing landscapes, commanding a vast ecosystem that spans across online retail, digital finance, logistics, and more. This diversified business model not only secures Alibaba's position as a market leader, but also offers a wide moat against competitors, positioning it well for sustained growth. Now, when it comes to the stock, I'm looking at margin of safety versus margin of opportunity. This stock is down some 76.31% from highs, but over the last couple of weeks, it's been staging some attempts to recover, and I believe it will achieve recovery. And when it comes down to it, folks, I mean, you're trading at levels where you can't say there's no risk, but virtually speaking, there's very, very little risk. You have insane amount of upside to get back to even half of the all-time highs, and the downside to even 2016 lows is very, very little in comparison. And the reason this is important is because this company is much better now as compared to where it was at in 2016. And their share count has actually been trending down since 2021 because they've been doing a lot of buybacks. You look at 2016, their price to free cash flow was hovering around 25. Today it's under 7. Bookings have gone from 15 to 64, and the valuation right now is just simply very, very compelling. If you look at analyst price targets, the average analyst price target is ranging from 84 to 147 with an average at $115, which suggests some 57% of upside. Now, the way that I see it, folks, is Baba is a center point in China's massive economy, and as that economy trends back upward over the next few quarters, I'd argue Baba is a steal. In terms of Baba's price, my opinion is that anything under $75 a share is really, really a cheap deal for Baba. Number 4, NVIDIA. So NVIDIA has been the hottest stock in this current bull cycle, and tomorrow they have their big GTC event. At tomorrow's event, they will be showcasing their latest architecture updates and introducing oodles and oodles of AI applications and predictions and exciting innovations. But markets have been running up into this, and my expectation is that it will be a buy the rumor, sell the news. 50-50 chance you get a 2 or 3 day continued rush on the price after the event, but right now it looks to be struggling to hold this leg of momentum, and I'd bet we get something similar to what we saw in mid-February, which was a dip from 737 to the low 650s. I could totally see the current trading at 880 go down to the mid 700s and then get bought up again, and that's going to be a nice opportunity. Right now, folks, I'm operating under the thesis that NVIDIA will break all-time highs at 974 and then go on to break the 1,000 key level ultimately. And so a dip back down to the mid 700s is a great buying opportunity, especially for those buying call options and leveraging their moves. Number 5, SoundTown AI. SoundTown AI specializes in developing voice-enabled AI and conversational intelligence technologies, allowing users to interact with products and services through natural spoken language. Their advanced AI system can understand, analyze, and respond to human speech, enabling applications across various platforms such as mobile devices, cars, and smart home devices to deliver interactive user experiences. Sound has recently gotten a lot of attention because of NVIDIA's stake in it. But anyways, the reason it is relevant right now is because it has a big catalyst coming tomorrow as well, and that's also NVIDIA's GTC. They'll be able to showcase their product in front of thousands of major investors that are watching that conference, and getting that kind of coverage as a small cap company is a big deal. However, the truth is that markets aren't anticipating this already, and that's why she's been running up so aggressively. So my take is let markets buy the rumor and sell the news, and once these dips dip back down to $5 or $6, that's when it's going to be a good deal again for the next push upward. And look, folks, I mean, we covered the stock many weeks ago, and we said, hey, this is a good buy at $3.54 a share. I don't think that you need to be greedy now that it's more than double. I think you got to be a lot more risk averse. course, right? Because at the end of the day, this type of stock needs a lot of catalyst energy and momentum and attention to continue going up. And so wait for the next dip. That's no problem. Anyways, that caps off today's video. Let us know which pick is your favorite in the comment section down below. Make sure to hit that ravishing like button and subscribe, and we'll see you in the next video.